your question to the chat box. With this note, let me start. Now, you may ask the question that in one way you are saying source of fund and cost of capital, but in the PPT, why it is only cost of capital? Because actually, once I will cover the cost of capital, sources of fund will be by default covered. Because if I ask you a simple question that what are the ways to raise the fund, obviously for a company, anybody, will you prefer to answer? Which are the ways to raise the funds? Khushbu, Shani, you want to answer? Actually, if you see, when we are talking about raising the fund, company can either take loan from banks or company can raise fund by issuing shares. So let me just jot it down. Sources of fund company may take loan from banks or it may go for public issue. That means when company takes loan from banks, it is borrowed capital. So when taking loan from banks, it is borrowed capital. So when it is going for public issue, if they are going for public issue of bond and debenture, again it is borrowed capital. But when they are going for public issue of shares, it is ownership capital. So basically, when we are talking about sources of fund, there are two types of funds: borrowed capital and ownership capital. Forget about the company. Think about an individual. Suppose I want to spend 20,000 in a month. I want to spend 20,000 rupees in a month. And I earn 10,000 per month. That means 10,000 is my own money. If I have to spend 20,000, remaining 10,000 I have to borrow. So 10,000 is ownership capital and remaining 10,000 is borrowed capital. Similarly, if company takes loan from the banks or company issues bond and debenture, then it is borrowed capital. When company is taking loan from the banks, that means company is borrowing from the banks. When company is when company is taking loan from the banks, company is borrowing from banks. when company is going for public issue of bond and debenture, company is borrowing from public. So both the cases it is borrowed capital. And when company is raising shares, it is ownership capital. So company can raise fund either via debt or via equity. Debt means borrowed capital. Equity means ownership capital. Now, when we are talking about sources of fund, when we are talking about debt capital and equity capital, so do you think is there any free lunch under the sky? No. So if I raise any capital, be it debt, be it equity, there will be certain cost associated with it. And that is known as cost of capital. So cost of capital, if you see in layman language, we can say minimum earning company has to earn to satisfy its different stakeholders. So again, there is a new term. We have heard about shareholders, that shareholders are those who are holding shares of the company. Now question will come, what do you mean by stakeholders? Anybody? Will you prefer to answer? Any? Shumit, Khushbu, Shayani? Anyone? What do you mean by stakeholders? Even if you commit mistake, nothing will happen. Let's make it an interactive session. I'm sure you have heard about stakeholders. What is it? Anything you want, you can share. See, stakeholders means, when we are talking about stakeholders implies, so let me define stakeholders first. Stakeholders implies different parties which have direct or indirect stake in the company. So, what can be the examples of stakeholders? Shareholders, they are the prime stakeholders. Management, employee, customer, creditors, suppliers, then tax authority or regulatory bodies, rating agencies, so each stakeholder has different expectations from the company. Shareholders, obviously they will look for profitability. They will prefer to maximize their wealth. And how can you ensure shareholders' wealth maximization? when market price of the share goes up. When market price of the shares will go up? When there is a adequate buying pressure of the shares. When there is adequate buying pressure of the shares, when company earns profit. So shareholders looks after for profitability. Management looks about management looks after ESOP, employee stock option plan, because management knows you know better. Shareholders are owners of the company, but they are electing the board of directors, and board of directors is appointing the management. So shareholder is the owner, but management is running day-to-day affairs of the company. Now, if management may think that whatever the blood and sweat I will offer for the company, at the end of the day, I am salaried employee. So if company earns profit, it will go to shareholders. So why I will give my sincerity, hard work to the company? So ESOP means employee stock option plan, where you are giving company share at a huge discount to market price to the middle management and top management to create owner-like feeling. What employee looks forward? Good compensation package. What customers looks forward? Quality product. At a cheaper rate. What creditors looks forward? Solvency of the company. Say banks, before sanctioning the loan, they will check whether company is enough solvent or not. What are the solvency ratios? Debt equity ratio, proprietary ratio, like that. Suppliers, what they will look after? Liquidity of the company. What are the liquidity ratios? Current ratio, quick ratios. Tax authority or regulatory bodies, they will look after compliance. Rating agencies, they will look after adequate disclosure. Depending on that, they will give the rating, whether it is ideal time to buy, whether it is ideal time to sell, or it is ideal time to hold of the company stock. So you have understood, stakeholders are those who have direct or indirect stake in the company. So once again, cost of capital implies minimum earning company has to earn to satisfy its different stakeholders. Or alternatively, you can say minimum cost that is incurred to raise the fund. So if I write here, alternatively, it can be stated that cost of capital is the cost incurred by the company while raising capital. From the market. If I go for IPO, FPO, right issue, initial public offer, follow-on public offer, right issue, I have to give advertisement, I have to appoint investment bankers, I have to appoint brokerage firms, I have to appoint underwriters, I have to appoint legal practitioners. So I have to give the fee for advertisement, for lawyers, for merchant bankers, for underwriters. There is a printing fee. I have to print the prospectus. So suppose in order to raise 100 crore rupees from the market, 5% is my cost. So I am raising 100 crore rupees, but in order to raise that, I am incurring a cost of 5 crore. That means 5% is my cost of capital. So what is the net profit of the company? So ultimately 95 crore is going to company's exchequer. Am I clear? This is called cost of capital. Tell me, up to this, anybody has any doubt? Okay. So first we are going to cost of debenture. Debenture, you know, it is a debt instrument. Here, cost of debenture means what is the cost while company is raising fund by issuing debenture. Formula of cost of debenture is R into 1 minus T plus F minus P by N whole divided by P plus F by 2. So R is coupon income from debenture, P is purchase price from debenture, F is redemption price. Now, what is the difference between purchase price and redemption price? Purchase price means when investor is buying the debenture from the market, how much price it has to pay. Redemption price means at the end of the maturity, how much amount company has to pay it back to the debenture holder. N is life of debenture, T is corporate tax rate. Now this formula of cost of debenture, that is KD is equal to R into 1 minus T plus F minus P by N whole divided by P plus F by 2. This formula is applicable when purchase and redemption prices are different. Let's take one example. Now, if purchase and redemption prices are same, that means if it is issued as well as redeemable at par, then what will happen? P equal to F. If P equal to F, then this term, second term in the numerator will disappear. So it will be R into 1 minus T by P. And when debentures are irredeemable at nature, in nature, N is tends to infinity. So cost of debenture is R into 1 minus T by P. Now, face value of 15% debenture, one example, is 1000. Debenture redeemable after 5 years is currently selling at rupees 900. Corporate tax rate is 30%. Calculate the cost of debenture. If this is the example, first you have to understand what is the purchase price? 900. What is the redemption price? If nothing is mentioned, it will be redeemable at par or face value. Redemption price is 1000. That means purchase price and redemption price are different. So we will go by the first formula, that is R into 1 minus T plus F minus P by N whole divided by P plus F by 2. Now, take the example 15% of 1000 face value. So what will be the coupon? 15% of 1000, 150. Tax rate is how much? 30%. So 150 into 1 minus 0.3. Redemption price is what? 1000 rupees. Purchase price is what? 900. And life is what? 5 years. Whole divided by 1000 plus 900 by 2. So if you put the values, you will get cost of debenture is 13.16%. And what is 13.16%? That means if company wants to raise fund by issuing debenture, company has to incur the cost of 13.16%. Next, face value per debenture 1000. Rate of interest is 10%. Issued at par. Redeemable after 10 years. Income tax rate 50%. Calculate cost of debenture. Tell me what will happen in this case. What is the purchase price? Face value 1000. What is the redemption price? It is issued at par, redeemable at par. That means purchase price and redemption price are same. If purchase price and redemption price is same, we will go by this formula, R into 1 minus P by P. So R into 1 minus P by P. R is what? 10% of 1000, 100. 1 minus T, 1 minus 0.5 divided by 1000. So it is 5%. Now face value, next problem. Tell me up to this, anybody has any doubt? No. Next problem. Face value per debenture is 1000. Rate of interest 10%. Issued at discount of 2%. Redeemed after 10 years. Income tax rate 50%. Calculate cost of debenture. What will be the purchase price? Issued at 2% discount. What is the face value? 1000. 2% of 1000, 20 rupees. That means purchase price is 980. Redeemable, if nothing is mentioned at par, 1000. So, again we have to go for formula 1, R into 1 minus T plus F minus P by N whole divided by F plus P by 2. So 10% of 1000, 100, tax rate 1.5, 1000 minus 980 by 10 whole divided by 1000 plus 980 by 2. So 5.25%. So when debenture is issued at discount, cost of debenture increases. Because when debenture is issued at par, cost of debenture was 5%. Just see. But when debenture is issued at discount, cost of debenture increases. Cost of debenture, why? Because when your company is issuing at discount, that means investors are paying lower price. So company's receivable is coming down. If company's receivable is coming down, but company's payables, redemption price is remaining the same, obviously company's cost will increase. So cost of debenture increases. Next, face value per debenture 1000 rupees. Rate of interest 10%. Issued at premium of 2%. Redeemed after 10 years. Income tax rate 50%. Calculate cost of debenture. What is the purchase price? Nothing is mentioned, so 1000 rupees. No, it is issued at premium. So 1000 plus 2% of 1000, 1020. What is the redemption price? Nothing is mentioned. So redemption price is face value 1000. So 1020 is the purchase price and 1000 is the redemption price. So purchase price and redemption price is the different. So in order to calculate the cost of debenture, we will use first formula, R into 1 minus T plus F minus P by N whole divided by F plus P by 2. So 100 into 1 minus 0.5 plus 1000 minus 1020 divided by 10 whole divided by 1000 plus 1020 by 2. So cost of debenture is coming 4.75%. Now you may ask, what has happened? That cost of debenture is decreasing because company is issuing the debenture at 2% premium. When company is issuing at premium, that means investors are paying higher price. When investor is paying higher price, receivable of the company increases. When receivable of the company increases, payable of the company remains same. So cost is going down. So have you understood how cost of debenture is calculated and how cost of debenture is changing depending on the fact whether debenture is issued at discount or debenture is issued at premium? Tell me, up to this, anybody has any doubt, any problem? Anybody has?
ডিসকাউন্ট এন্ড প্রিমিয়ামটা একবার বলবেন?
Sure. Discount and premium. See, first, this example we are saying it is issued at par and it is redeemable at par. So issued at par and redeemable at par, that means issue price is equal to redemption price. So P equal to F. So we are going for second formula, that is R into 1 minus T by P. 10% of 1000, 100 into 1 minus T by 1000, 5%. Now see, here it has been said face value is 1000 but it is issued at discount. Now company is issuing debenture at 2% discount. So 1000, 2% is how much? 20. So 1000 minus 20, 980. That means purchase price of the debenture is 980. Though face value of the debenture is 1000, but investor is buying at 980. But it will be redeemable at face value 1000. So then purchase price and redemption price is different. So I will use the formula 1 R into 1 minus T plus F minus P by N whole divided by F plus P by 2. So when we are putting the values, we are getting 5.25%. So when debenture is issued at discount, cost of debenture increases. Why? Because when debenture is issued at discount, that means debenture holder or investors of debentures, they are paying lower price than the face value. So if they are paying lower price, company is receiving less, but company is giving redemption at face value. That means company's receivable is less, company's payable is more. If receivable is less, payable is more, cost of debenture increases. Am I clear? বুঝেছো?
Yes, sir.
Now see, when it is issued at premium, next problem, at 2%. That means instead of issuing at 1000, it is being issued at 1020. So investors are paying 20% higher. So purchase price is 1020 and redemption price is 1000. So when purchase price and redemption price are different, again we will go for the formula 1 R into 1 minus T plus F minus P by N whole divided by F plus P by 2. So here when we are doing the calculation, we are getting 4.75%. Logic is simple. Company is issuing debenture at 2% premium. That means investors are paying 2% more than face value. So company's receivable is more, but company's payable is less. So cost of debenture decreases. Am I clear? Now tell me, issued at discount and issued at premium, is it clear to all of you? বোঝা গেছে? Can I proceed? Okay. So, next, it is redeemable at 2% discount after 10 years. That means purchase price is 1000, redemption price is 980. Again, purchase price and redemption price is different. We'll go for the formula 1, R into 1 minus T plus P minus plus F minus P by N. F is redemption price. It is redeemable at 2% premium. So 980 minus 1000 by 10, whole divided by 1000 plus 980 by 2. So cost of debenture is 4.85%. If debenture is redeemable at discount, cost of debenture decreases. Why? Because company is redeeming at 2% discount. That means company is paying 2% less. If company's receivables is same but company's payable is less, company's cost decreases. On the other hand, if you take another example where company is redeeming it at 2% premium, that means company's debentures purchase price is 1000, but it is redeemable at 2% premium. That means redemption price is 1020. Then again, you will go by the formula 1, that is R into 1 minus T plus F minus P by L whole divided by F plus P by 2. So 100 into 1 minus 0.5, 1020 minus 1000 by 10 divided by 1000 plus 1020 by 2. So 5.15%. Now, when debenture is redeemable at premium, cost of debenture increases. Why? Because when company is redeeming at premium, what will happen? Company is paying more, receiving less. When company is paying more, cost will increase. Now, tell me, up to this, anybody has any doubt? Any question? Khushbu, Shani, Shanchari, Shomit. Now I'll ask a simple question. Question is that, since you are not asking any questions, so I'm asking question on your behalf. That fine, sir, from the beginning you are saying R into 1 minus T. When purchase price and redemption price is different, then R into 1 minus T plus F minus P by N whole divided by P plus F by 2. When purchase price and redemption price is same, then what will happen? Formula is R into 1 minus T by P. Now, why this 1 minus T? Can you tell me? Why this 1 minus T? T is tax rate. Why in cost of debenture always we are saying 1 minus T? In finance, everything is all about logic. When company is paying interest, company is enjoying tax shield. So, it is R into 1 minus T. Am I clear? Now, face value per debenture 1000, rate of interest 10%, issued at par, income tax rate 50%. Calculate cost of the irredeemable debenture. Irredeemable debenture means debenture which will never be redeemed. In UK, there is a bond called console bond. This bond has infinite years of life. That means interest will be paid over the life. There is no redemption. Now, when there is no redemption, that means n tends to infinity. If n tends to infinity, let's come to the formula. This is my general formula. R into 1 minus t plus f minus p by n. If n tends to infinity, 1 upon infinity is 0. That means this term is becoming 0. So R into 1 minus t by p. So R into 1 minus t by p is the formula. We're putting it, we're getting 5%. Cost of irredeemable debenture when it is issued at discount 2%. R into 1 minus t. R into 1 minus t divided by p, because it is issued at 2%. So p is 980, 5.1. When it is issue price is going down, company's receivable is less, cost of capital is increasing. But when it is issued at premium, so 1020, company's receivable is more, cost of debenture decreases. Then we are coming to preference share. Can you tell me what's the difference between debenture and preference share? Anybody? What is the difference between debenture and preference share? Shomit, Khushbu, Sanchari, Shani, anybody? Debenture is a debt capital. Debenture is debt capital. Preference share, here shareholders will get dividend at a fixed rate, and preference share is also redeemable. In India, all preference shares are redeemable. That is, they have the maturity period. So if it is a preference shares of 5 years, for 5 years it will get dividend, investors will get dividend, then investor will get the money back. Now, cost of preference share formula, just if you compare, in debenture we are getting interest, so we have started with R. In preference we are getting dividend, so we are starting with D. When company is paying interest to the debenture holder, company is enjoying tax shield, so R into 1 minus T. But when company is paying dividend to shareholders, no tax shield is enjoyed, so no 1 minus T. But remaining part is same, F minus P by N, P plus F by 2. P is the purchase price, F is the redemption price. Now this is the formula of cost of preference when purchase and redemption price are different. When purchase and redemption price are different. Now when purchase and redemption price are same, so cost of preference share is D by P. That means F equal to P. When preference shares are redeemable in nature, N tends to infinity, so again cost of preference is D by P. A company has issued preference share which is offering 10% dividend with face value of 100. Preference share will be redeemable after 8 years and it is currently selling at 80 rupees. Corporate tax rate is 30%. Calculate the cost of preference share. So what is the purchase price here? 80. What is the redemption price here? 100. So we'll go by the first formula. D plus F minus P by N whole divided by P plus F by 2. So what? We'll put the formula. 10% dividend, 10% of 100, 10, 100 minus 80 by 8, whole divided by 100 plus 80 by 2. So cost of preference is 13.89%. Now again, face value per share is rupees 50. Rate of dividend 8%, issued at par. Calculate cost of irredeemable preference share. When preference share has no redemption, N tends to infinity. So this second term in the numerator will vanish. So it will be D by F. So see, 50 rupees face value, rate of dividend 8%, issued at par. So 50 into 0.08 by 50, 4 by 58%. When it is issued at discount of 5%, that means face value is 50, but it's issued at 5% discount. 50 minus 5% of 50, that is 47.5. When it is issued at discount, your cost of preference increases because company is issuing at discount. Investors are giving lesser price. So receivable is less, payable is more. Cost is increasing. Face value per share, 50 rupees. Rate of dividend, 8%. Issued at premium, 5%. Issued at premium 5% means 50%, 55%, 52.5. So purchase price is 52.5. So 4 by 52.5, it is 7.6. So instead of 8%, it has come down to 7.6%. When preference share is issued at premium, cost of irredeemable preference share decreases. Logic is simple. It is issued at premium. Investors is paying more. Company is receiving more. If company is receiving more, paying less, cost of capital decreases. Tell me, is it clear? Any doubt so far? Shumit, Khushbu, Sanchari, Sharni, any doubt? Is it okay? Can I proceed? Okay. No. Face value 100, rate of dividend 10%. Issued at par, redeemed after 10 years. Calculate cost of preference share. D by P, 10 by 100, 10%. Face value per share 100, rate of dividend 10%. Issued at premium 5%. Redeemed after 10 years. Calculate cost of preference shares. Now here what will happen? Purchase price is 100 minus 100 plus 5 because issued at premium, 5% premium. So 105. Redeemable at 100. So purchase price and redemption price are different. If purchase price and redemption price are different, we will go for the first formula. So cost of preference share is equal to D plus F minus P by N whole divided by F plus P by 2. So 10 plus 100 minus 105 by 10 whole divided by 100 plus 105 by 2. 9.27%. See, when preference share is issued at premium, cost of preference decreases. Logic is simple. It is issued at premium. Company is receiving more. So if company's receivable is more, payable is less, cost of preference decreases. Face value per share 100, rate of dividend 10%, issued at discount 5%, redeemed after 10 years, calculate cost of preference share. So issued at 5%, 95 purchase price. Redemption price is 1000. Purchase price and redemption price different. So first formula will come D plus F minus P by N whole divided by F plus P by 2. So 10 plus 100 minus 95 by 10 whole divided by 100 plus 95 by 2. So 10.5 by 97.5 is equal to 10.76%. So when preference share is issued at discount, cost of preference increases. Logic is simple. Company is giving 5% discount, so company is receiving less. When company is receiving less, paying more, company's cost increases. Face value per share 100, rate of dividend 10%, issued at par, redeemable at 5% premium. Tell me what will happen. Purchase price is 100, redemption price is 105. Purchase and redemption price are different, so we'll go for first formula. What is first formula? D plus f minus p by n whole divided by f plus p by 2. So 10 plus 105 minus 100 by 10 whole divided by 105 plus 100 by 2. So 10.24%. So when it is redeemable at premium, that means company is paying more, but company is receiving less, so company's cost is increasing. On the other hand, when it is redeemable at 5% discount, that means what? Purchase price is 100, redemption price is 95. Redemption price is 95 means company is giving less, company is paying more. So see, when company is giving less, when company is paying less, getting more, so company's cost of preference is decreasing 9.74%. Tell me, up to this, anybody has any doubt, any problem? Am I clear? বোঝা যাচ্ছে? খুশবু, সঞ্চারী, সায়নী? Then I'm coming to cost of equity shares. Cost of equity share, it is historical rate of return, average dividend plus average capital gain by initial price per share. There are different methods of cost of capital. What is the example? 3 years ago, price of share was 100 rupees per share. Dividend paid each year was 10. Current market price is 130. That means purchase price is 100 rupees 3 years ago. Selling price is 130 after 3 years. That means you are getting capital gain of 30 rupees. What is your average annual capital gain? 30 by 310. What is your dividend in each year? 10. So dividend plus capital gain 10 plus 10 into 100. Into 100. That is 20%. So cost of equity is 20%. Now earnings price ratio. What is earnings per share divided by market price per share? This is another method of calculating cost of equity. Let's take one example. Share capital of a company comprises 10,000 equity shares of 10 rupees each. Market price of each share is rupees 20. Earnings available to equity shareholder is 30,000. So earnings per share is how much? Earning divided by number of outstanding shares, 30,000 by 10,003. Market price per share is 20. So 3 by 20, 15%. Now earning per share, if you see, this is just reciprocal of price earning ratio. Price earning ratio, I'm sure all of you have heard. What is this price earning ratio? Market price per share divided by earnings per share. So if price earning ratio of company A is 20 and price earning ratio of company B is 40, that means with respect to company's earnings, A's price A is available at 20% higher price. With respect to company B's earnings, stock is available at 40 times higher price. So if price earning ratio is 20, what will be the earning per share? 1 by 20, 5%. If price earning ratio is 40, what will be the earning per share? 2.5%. That means lower price earning ratio has higher cost. Higher price earning ratio has lower cost. So what is the takeaway? Takeaway is when price earning ratio is lower, that means price is comparatively less. If price is comparatively less, cost is comparatively high. When price earning ratio is more, price is comparatively high. When price is comparatively high, cost of equity is comparatively less. So earning price ratio is nothing but reciprocal of price earning ratio. Now another formula, another method of cost of equity, dividend growth model. D by P plus G, expected dividend per share divided by market price per share plus growth rate in dividend. Face value per share is 10 rupees, rate of dividend 20%, growth rate in dividend 5%, market price per share 20 rupees. D 20% of 10, 2. So 2 by 20, D by P plus G, growth rate 0.05%. So it is 15%. Now earning growth model, K is equal to E by P plus G, earnings per share divided by market price per share by growth rate. Earnings per share rupees 3, growth rate in earnings 10%, market price per share 20 rupees. So E is equal to 3, P equal to 20, growth equal to 10%. So 3 by 20 plus 0.1, 0.15 plus 0.1, 0.25, so 25%. Tell me, up to this, anybody has any doubt? Please ask me the question. Shani, Shanchari, any doubt? Okay. Then cost of term loan. What is term loan? When company is taking loan from the banks. Cost of term loan formula is R into 1 minus T. R is interest on term loan, and when company is paying interest on term loan, company is getting tax shield, income tax exemption. So R into 1 minus T, interest into 1 minus corporate tax rate. Company has taken loan from banks at 14% interest, corporate tax rate is 30%, calculate cost of term loan. 0.14 into 1 minus 0.3, so 9.8%. Just try to understand. Company is paying 14% interest. But on this 14%, company need not pay tax. So what is the 30% of 14%? 4.2. So 14% interest they are paying, but 4.2% tax they are saving. So ultimately, cost of term loan comes down to 14 minus 4.2, 9.8%. Now cost of retained earnings. What is retained earnings? When company earns profit, first company will pay corporate profit tax, then company will pay dividend to the shareholders, then remaining part it will keep as reserve and surplus. Now this retained earning, who will be the owner of retained earning? Equity shareholders. So cost of such retained earning will be considered as opportunity cost involved, because simply it is dividend foregone by the shareholders. So cost of retained earning will be exactly same as cost of equity share. Now pre-tax and post-tax cost of capital. If you see, pre-tax and post-tax cost of capital is same for equity and preference. Because for both the cases, there is no adjustment in tax. Because when you are paying dividend to equity and preference shareholders, no tax exemption is enjoyed. But pre-tax and post-tax cost of capital vary for debt instrument. What is the formula? After tax cost of debt is equal to pre-tax cost of debt into 1 minus T. So if pre-tax cost of debt is 12% and prevailing tax rate is 30%, so after tax cost of debt is 0.12 into 1 minus 3, 8.4%. That means you are paying 12% before the tax. But since you are paying 12% interest, so 30% interest you are saving on tax. So 30% or 12%, 3.6% you are saving, 12% you are paying, 3.6% you are saving. So 8.4% is your final cost of debt. Am I clear? Tell me, up to this, anybody has any doubt, any problem? So now, impact of flotation cost on cost of capital. Flotation cost means when company goes for public issue of debt and equity, it has to incur certain expenses, such as printing, marketing, and legal expenses. This is known as flotation cost. So if I'm saying flotation cost is 5% and the market price is 100, that means company is charging 100 rupees, but company has to incur a cost of 5 rupees. So net profit is 95. So flotation cost reduces net profit from the instrument. Hence purchase price is reduced to the same extent of flotation cost. Though investor is paying same price, it enhances cost of capital. So I've discussed how to calculate cost of debenture, cost of preference, cost of equity, cost of term loan. I've also discussed what will happen when instrument is issued at discount, what will happen when instrument is issued at premium, what will happen when instrument is redeemable at premium, what will happen if instrument is redeemable at premium. So this is a brief presentation on cost of capital. I hope you have understood. If you have any question, you can ask. And if there is no question, so yeah, please, Shani.
প্রেফারেন্স শেয়ারে কি কর্পোরেট ডিভিডেন্ড ট্যাক্স অ্যাপ্লিকেবল হয়?
No, no. Preference share, see. Preference share, when company is paying dividend, company is not paying any tax. Company, because nowadays, earlier there is a concept called dividend distribution tax. When company has to pay the dividend, company has to pay the dividend distribution tax. But after that, in last 2 years budget, it has been stated that when company pays dividend, company will not pay any tax, but dividend is taxable in the hand of assessee. But please remember, when company is paying interest to the debt holder, company is enjoying tax shield because company is saving the tax. But when company is paying dividend to the shareholder, company is not enjoying any exemption. Okay, Shani?
ওকে স্যার।
Okay. So if there is no other doubt, so today I am concluding my session. Thank you very much for your patience hearings. Thank you. So
থ্যাংক ইউ স্যার।
thank you so much. Okay.